begin by the report at large. It's navigating uncertainty. And of course, we appreciate there have been trade tensions among advanced economies, and we've seen a bit of softening of growth. Just why navigating uncertainty, to be precise?
So what we've seen is some softness in the growth numbers coming out of the region. Overall, we had expected, for the region as a whole that is, we had expected growth to accelerate from 3.2 last year to around the 3.6 mark. It now looks like that uncertainty is not going to happen, and growth will remain at around 3.2% mark, accelerating to 3.6% next year. Now, within this, it's always important that there's quite a lot of variation in growth rates in sub-Saharan Africa. So we still have about 25 countries, mainly the diversified economies, continuing to grow fairly rapidly, 6% or so. Kenya, Tanzania, Ethiopia, Ghana, Senegal, Cote d'Ivoire, all growing very robustly, and many others. But commodity export reliant countries are growing, growth remains weak by and large. But even in the faster growing countries, we've seen some softness. And we're associating this with the weakness in the trade environment globally. And commodity prices have softened, but also in general, trade volumes have declined. And we think this is what's impacted growth a little bit. So for about 2/3 of the countries in the region, we've marked growth down by about 0.2 percentage points on average. So there is some softness to growth outcomes.
I see. I was reading the report and seeing the indication that inflation is expected to ease. And one of the implications says that there will be room for more accommodating monetary policy. But on the other hand, we've seen, especially in some countries, some FX vulnerabilities. How do you see this playing out? Because it would be a bit of a tricky balance for most economies.
Indeed. What will help, and as you said, in most countries, inflation remains really under control. In fact, so much so that we no longer even produce inflation charts when we're doing presentations on the region, because there's only a handful of countries where inflation is above 10% in the region. So inflation pressures remain contained for the most part. What will help? So I think in wherever countries see inflation under control, there will be scope to reduce interest rates, subject, of course, to what they want to happen with the exchange rates. Now, what will help in general is that, globally, there's been some easing of financial conditions. The major central banks have been lowering rates. Other emerging market countries have followed and have been lowering rates. So that will also give countries some room. And indeed, we've seen some cuts in the region over time. As always, the conduct of monetary policy has to be data dependent, and really with an eye to what you expect to happen over the horizon. And our advice really is that we see more space on that side rather than on the fiscal side, should there be more evidence of a growth slowdown.
Okay. And speaking about the fiscal side, the report, of course, indicates there are limited buffers in terms of countervailing pressure that may come in. Can we just delve into this and how the landscape is like across the region?
So a key challenge that has emerged over the last couple of years is levels of debt, which have been trending upwards in most countries in the region. A big reason for this was the commodity price shock, which of course hit those commodity exporting countries very severely, reduced economic output, export revenues, fiscal revenues. So debt pressures have been mounting in many of those countries. But in other countries also, countries like Kenya, we've seen debt levels drifting up over time, reflecting all the investment that's being undertaken in infrastructure, in health, education, and other important development areas. What we, one thing that has started to happen in the last year or so is there's some signs of stability in debt to GDP ratios. So debt levels have begun to stabilize in most countries again. And what we feel is a priority going forward is to sustain that, stability in debt levels, particularly by generating more revenues. where tax to GDP revenues in the region tend to be below potential in most countries. There's a lot of scope to tap that and mobilize more revenues. And the important thing about mobilizing more revenues is that you can create more spending space to address the still ongoing development needs, of course. And part of it can be allocated to reducing deficits somewhat.
I see. And talking about the deficit and the drifting upwards, something happened in Kenya 2 weeks ago where the parliament passed a revision of the debt ceiling from 50% of GDP to 9 trillion shillings. And from where I sit, my biggest concern was around we're moving from a ratio to a nominal figure. And of course, the vulnerabilities around this in terms of inflation went out of control, or FX on the side. I'm wondering, what are your thoughts around this?
So I don't know the specific details, but nominal debt target ceilings are not uncommon. I mean, the United States, I believe, has limited the debt stock level controlled by Congress, and it's adjusted from time to time. Now, the key thing really with fiscal policy in Kenya is we've seen debt levels go up, but by and large reflecting all of the investment that the government has been undertaking in infrastructure. But what hasn't been done enough is to capture the rate of return on all this infrastructure investment. So what's needed is, we feel, getting the revenue to GDP up by between 0.5 and 1 percentage points each year over the next 3-4 years. If the government could do that, it would be, put public finances on a really very robust footing. The debt level right now is sustainable, so there's no issue with that. The key going forward is to make sure that there is more room for development spending. The government has a big 4 agenda, as you know. So if those are to be addressed, God forbid if there's an adverse economic shock, and if that's to be accommodated, you need more revenue space. And so that's what we're talking about, and that's what our key policy recommendation for Kenya is.
Okay. And just to circle back a little bit to monetary policy, we're now in an environment in this country whereby the president sent a memo back to the National Assembly in terms of the rate cap, which has been a long-running issue. And the recommendation is to get rid of it in the finance bill of 2019. Of course, this is now pending in Parliament. I wonder how IMF views this position. This has been a key discussion in this country.
Yeah, I mean, so we've been very clear on this. This is the rate cap introduces a distortion into the money market. And also has been impacting could have a bearing on monetary policy conduct. So we have pointed out that it is a distortion. We recognize, of course, the deep political debates that have been taking place here, and have left it for the political dialogue to settle the final position on this. Is it like something which has helped? The intended target were small and medium scale enterprises. Has the introduction of this cap helped? I think the evidence is to the contrary. It hasn't helped, and frankly, not just here but elsewhere, where these kind of interest caps, particularly at a level where they impinge. They can impinge rate setting, have been introduced. The experience has been that they're not effective. They don't serve the intended target. I think what is needed to really facilitate more access to SMEs is making sure, of course, the financial sector remains robust, well-regulated. You also want to introduce the other foundations for really dynamic and deep financial market, things like credit reference bureaus, making sure that the insolvency courts work very rapidly, effectively at allocating collateral to whoever it belongs to. So those kind of foundations are as important, we feel, for ensuring that you have deep and sustained access for SMEs. I think that's what needs to be working on. But we're watching the debate very closely, and see how it goes.
Okay. And as we get to the tail end of the conversation, let's talk about the resilience of the banking sector across the region. First of all, what's your view around how African banks, or Sub-Saharan African for that matter, have absorbed this IFRS 9 transition? And then the report speaks at length about the issue of cross-border expansion vis-a-vis the oversight. If you could just speak a little bit into that.
So, one of the things we've been highlighting over the last 8-10 years, frankly, has been the emergence of Pan-African banks. South African banks, Nigerian banks, Moroccan banks, of course, and even Kenyan banks, right, expanding into the region. by and large, this is, I think, a really welcome development. It shows financial integration. In many cases, these banks are following firms, that are investing abroad or doing business in other African countries, and looking to continue servicing them in other territories. So really is a welcome development. At the same time, it puts the onus on strengthening cross-border supervision, collaboration between central banks to make sure that financial sector banks remain as robust as possible. These regulatory adjustments, by and large, I think we feel banks have been, complying with them, and they've been going well. But as always in the financial sector, because it can be a source of vulnerability, should there be problems in banks, with very significant fiscal implications, it's always very important to make sure that banks are complying and upgrading their both accounting standards, but also other aspects of their work, AML, CFT monitoring, and the like. So, these developments are by and large, consistent with what you'd expect with the level of development and continuing integration of African markets.
Okay. And my final two questions, because I'm out of time as directed here. One is that what is your assessment of how we conducted the demonetization exercise? And then the second one is, if Kenya went back to the commercial market today, do you feel we'll get as attractive a yield as we've been getting in the past?
So the demonetization, by all accounts, seems to have proceeded quite well. Logistically, it seemed, to have been implemented as well as it can be expected, and so kudos to the efficient and effective implementation of it. On access to financial markets, there remains quite a lot of risk appetite for, I think, Kenya. As always, when you want to access markets, it depends on market conditions at the conjuncture, indeed global conditions. Of course, I don't have no doubt Kenya will be able to access financial markets, when it wants to, and because the policy management remains strong. But the key issue really is, financial market access in and of itself is while very good, in and of itself doesn't solve the development challenge or the development problems that countries have. So the key really remains the domestic policy calibration. It's been good so far in Kenya, and what's needed is to make sure that fiscal policy can remain on a robust path, including to shocks and to a growth slowdown. God forbid that happening. So that's the direction in which Kenya needs to travel.
All right. Thank you for your time.
Thank you.